Now we're going to continue to discuss monetary policy, and I want to think about this as if you're attending a school for central bankers learning how to run monetary policy. The topic for today are two. One is the Fed's balance sheet, or the balance sheet of any central bank. And second, this idea of quantitative easing, which is a new phenomenon in central banking, which has become quite common and actually quite controversial in central banking circles and in economic policy making in general. So let's start with the Fed's balance sheet. Just like any organization, a bank, commercial bank, the Fed has a balance sheet. And traditionally we put assets over on the left and liabilities over on the right. We're going to use an illustration of the Fed's balance sheet in August of 2007. So some of the assets of the Federal Reserve are the securities it holds. Those could be the U.S. Treasury securities that it may have purchased as part of its open market operations. The Fed also gives loans, makes loans to commercial banks, so it could have some loans on its balance sheet. That's an asset. In 2007, the sum of securities and loans was $850 billion. The actual balance sheet of the central bank is considerably more complicated than this, but what we've been able to do is to simplify it to get to the gist of what the issues are. So we're not going to list all the different securities and all the different loans. We're going to put them together as a total, the total being $850 billion. At the bottom, I've just made a note that of that $850 billion, 800 is Treasury securities, and the Fed is not holding mortgages or mortgage-backed securities. Mortgage-backed securities are securities that are based on collections of mortgages, hundreds of mortgages that are really the backing for the security. We're not assuming that the central bank holds any of those for the time being. So it's $800 billion in U.S. Treasury securities and $50 billion in loans to banks. On the liability side, two familiar things is the currency, which is $840 billion, and reserve balances, or these bank reserves at the Fed, which were about $10 billion in August of 2007. So that's the balance sheet, and you can see this is pretty much reflects what the central bank traditionally does. It provides for the amount of money in the economy, both through currency and through reserve balances. Reserve balances affect the amount of deposits that people hold. And as it changes currency plus reserve balances, it changes securities and loans, since the asset side of the liability must move when the liability side. Any change in liabilities must be matched by changes in assets. And those are examples of the open market operations we discussed. Now, to think about how the balance sheet changes over time will get us into quantitative easing. So let's move forward in time and look at the balance sheet in November of 2013. I moved quickly, so let's look at the numbers. The items are the same, securities and loans on the left, currency and reserve balances on the right. Securities and loans is quite a bit larger than it was in 2007. It's $3,800 billion compared to $850 billion in 2007. So that's quite an increase. If you look at the bottom, you can see that increase has been due to more Treasury securities being held, now $2,200 billion, and mortgage-backed securities of now $1,400 billion rather than zero. Of course, the increase in assets has to have been matched by the increase in liabilities. That's how the Fed has actually paid for the purchases of the securities. And you can see in this case that the currency is up, but what is up much more is reserve balances. Reserve balances were only 10 in 2007, and now they're 2,500 billion. So that's a big change in the balance sheet. And when people say the Fed's balance sheet has grown, sometimes they'll say the Fed has a bloated balance sheet. The balance sheet is bigger now. This is what they mean, that both the assets and the liabilities have increased substantially. This is a big balance sheet in November 2013 compared to a much smaller balance sheet in August of 2007. Now let's look at what has happened between these two periods of time, and that will illustrate the idea of quantitative easing. So let's look at a couple pictures to help us with this. This is a picture that just shows you those reserve balances that I showed in the picture, in the balance sheet. And so on the horizontal axis, you have billions of dollars, up to 5,000 billion. And the horizontal axis, there is the years, 2000 up to 2015. What's called liquidity operations are largely those loans to banks to help them in periods of crisis. So the liquidity operation that points to 9/11, that's 9/11/2001, when due to the terrorist attacks, there was a lot of physical damage and destruction in Wall Street, and so that impaired the functions of the banks. And to help the banks get going, loans were made. And so you can see, actually it's hard to see, but you can see a little blip with $60 billion. And then it was pulled out after the banks got going again. So that was an example of providing loans to banks who were in difficulties because of this attack. The next big blip is in 2008. That's during the panic of the financial crisis, where people started taking their money out of banks. Questions about the bank's viability. And so here the Federal Reserve provided loans. Again, we're calling that liquidity. It's providing liquidity to the financial system. And that's caused reserve balances to rise. So the movement in reserve balances tells you a lot about the actions of the Fed. In this case, these liquidity operations diminished as shown here. The loans to banks went down after the panic was over. The Fed had already also made loans to foreign central banks, so they in turn could provide loans to their banks. And those also diminished after the panic was over. And so there was this wind down in these liquidity operations. However, that was not the end of the actions of the Federal Reserve. In fact, things happened like this. This was the decision that's called quantitative easing. And at this point, after the panic subsided, there were concerns about whether the economy was going to recover well, whether it was going to grow well. And so additional actions, quite unusual actions, were taken. Some of these actions were taken because of the interest rate hitting its lower zero bound and the Fed looking for other things to do to stimulate the economy. QE1 is quantitative easing 1. That was the first bout or tranche of purchases of hundreds of billions of dollars of U.S. Treasuries and mortgage-backed securities. The purchases of the mortgages was to try to help the housing market, try to get the interest rate down. And the logic is pretty simple. It comes from the financial market models and bond pricing we've discussed. As the Fed buys more bonds, it raises their price, and that should get the interest rate to decline. That's the concept that the Fed was using to engage in QE1. After QE1, the economy didn't really get going very much, so they decided to do another bout of quantitative easing, which is now called QE2. And that is quite evident in the picture. Financing that caused reserve balances to rise by another large amount. And then, again, the economy didn't do so well in response. We don't know all the reasons. The Fed was hoping it would do much better, but it didn't. Maybe this wasn't working. Maybe something else was going on. But in any case, the Fed decided on a QE3, and that's what's shown in the right-hand side of this line. The beginning of QE3, which, as I speak, is still going on, is shown by the blue line. And where it comes afterwards in the future is by the red line. QE3 is purchases of treasuries and mortgage-backed securities to the sum of $85 billion per month. So every month the Fed will buy another $85 billion in treasuries and mortgage-backed securities. And as they do, this line rises. You can see it's risen along the blue line already, and it will continue to rise as long as the Federal Reserve continues to buy $85 billion a month, as shown in the picture. It was never very clear when this was ended. QE3 was announced to start at the end of 2012. It was an announcement in September 2012 and December 2012. And then it started going, and it's continuing to go. However, in the middle of 2013, the Fed began to hint that it might not buy so many bonds over time. The chairman of the Federal Reserve, Ben Bernanke, in congressional testimony, hinted that perhaps in the next few open market committee meetings, they would begin to reduce the size of the purchases. That was called tapering. And so tapering is the lingo that has developed around this, which simply refers to the idea that the Fed will purchase a smaller amount of securities, not sell them, but just purchase a smaller amount. You could call that the new QE3 that was announced at least tentatively in May and June of 2013. And you can see this is what the tapering was. The idea was to slow down by the end of 2013 and then actually stop additional purchases in 2014. So that's what the black line indicates. There was a huge adverse reaction in the markets to this decision to announce the tapering. Interest rates rose, went the reverse direction from what the Fed was hoping with quantitative easing, raised a lot of questions in the markets about the effectiveness of quantitative easing. And basically the Fed therefore reversed path and decided not to do the tapering and actually go to QE3 again, which you could call as a new QE3, where you're basically back on that path without the idea of tapering. But this issue has continued to raise questions. Eventually this will have to be stopped. You can't keep that line going on forever. And in addition, it's probably going to have to come back down at some point, back to the original level where that green line was in the first place. And that means selling huge amounts of treasuries and mortgage-backed securities. And that it begins to worry market begins to worry about what that impact would be. So as we speak, the Federal Reserve is trying to decide how to do this. But from now, you can see a few things. First, you can see what quantitative easing is. Second, you can see how you can describe this with the balance sheet and that most of the action can be summarized with these reserve balances. And you can see how unprecedented it is compared to the past. This is not just a regular kind of monetary policy. It's very unusual. Its purpose is to try to drive long-term interest rates, mortgage rates, and bond prices down to stimulate the economy. It's questionable how much impact it has. There's debate about that. And then finally, you can see to undo this is not easy. Just hints of undoing it cause turbulence in the market. So this is the brave new world of central banking. It has to do with quantitative easing. Very important to understand this in order to have a sense of what central banking is about today. Thank you very much.